The Rebel Capitalist Show. I am a long-term investor. I like buying stuff and like holding it forever. Most people know that, but I do think there's value in understanding trading. It's more short-term, but then even if you are a long-term investor, I think there's an edge if you understand options. So you can kind of work around your position and get more of a return over the long run if you know what you're doing. So that's why I invited you on today to talk about not only options, but talk about something that's on everyone's mind, and that is gold.
There's a cyclicality to gold that works in the, and I've talked about it at your Rebel Capitalist show, and we'll talk about it moving forward. But what I wanted to highlight here was just the psychological path that the cyclicality of securities has, which is when things are going up, like imagine when Bitcoin and uranium were going up, there's optimism, excitement, thrill, euphoria, everything's making money, everything feels great. Then when you're going through the downtrend, you have denial, fear, panic, capitulation, you get depression, like it's like you're disappointed there. And as investors, we go through these emotional cycles. And the point of maximum financial opportunity is to buy when everyone else is depressed or not paying attention or simply not interested in a security. Think of when buying coal miners or uranium stocks a year or two ago when nobody wanted to touch them and they were literally selling 10 cents on the dollar. Today, now everyone wants to own them and they're willing to pay.
I bought them back in March of 2020. I remember.
Fantastic. Yeah. And now everyone wants to own them hand over fist 10 times higher than when they were trading there. But if you were buying those securities at the point where no one was interested, that point of emotional capitulation, that's when you get the best price. That's where your biggest asymmetry exists. What I wanted to just highlight is that I've presented this before, that the gold miners, when measured by, I was taking bull and bear cycles that have to at least be 2 months in length and a percentage move in the market of greater than 20%, either down or up to count a cycle. And when we overlay the different gold miner cycles that have happened, what you find that since its inception of the creation of the ETF back in 2006, there were 9 of those cycles. The average length of the up cycles have been 11 months and the average duration of the cycle down was 8.8 months. And look at the magnitude of the average rise and the average fall during this period. Like literally, the gold miners get halved during a down cycle, and they double when they go through an up cycle. And so this happens over and over again. And when you're at the bottom of one of these cycles, down 40%, you go back to this depression thing. You're depressed. You're upset. You're capitulating. You're not interested in what's happening, but ultimately what ends up happening is that the next major opportunity on the upside almost invariably happens, and this amazing opportunity to make money comes on the other side of these cycles. And so what I want to do is talk about options. Now, I've done at your Rebel Capitalist Live the presentation of using long dated leap options as a way of trading these cycles, but I want to today give something new. That's something we've already talked about in the past. What I want to talk about is 2 circumstances. Number one is that how do you repair a gold mining position that you have that is now losing money? So some people may have really loved the gold trade and got in 6 months ago and now find themselves in a situation where they're down on their existing gold mining position. How do you repair it? And then the second thing I want to cover is if we are in fact at one of these turns, how do I put on an asymmetric trade to leverage the upside while not exposing myself to that same leverage downside risk? So let's, George, let's take a moment and just give everyone a quick primer on how options work. Just because in order to understand this, we need everyone to be somewhat on the same page. So let's just quickly, I don't want to waste a lot of time on this, but let's just give everyone this primer of an option is a contract between 2 counterparties, a buyer and a seller. And the buyer of an option, whether it's a call option or a put option, is paying money out of their pocket to secure a right to buy or sell the security at a specific price over a specific period of time in the future. And so I always like to use that example where me and you are making a deal, and you, let's say, own shares of a gold miner. I want those shares. We can enter a contract and say, we agree that you have I have the right to buy those shares from you at an XYZ price, whatever dollar price we assign to it at some point in the future, but I must pay you money for that right. As you're not going to agree to do this with me unless I'm offering you some sort of compensation for as income for you doing this. So the seller of that option is paid the income for the undertaking that obligation to buy or sell to that buyer. And so what we're going to, in this example, just talk about the relationship of an option, particularly the call option, the right to buy an underlying security. And so when we're talking delta, which is the rate of which the option is trading in correlation with the stock, something that has a delta of 0 means that it's uncorrelated to the security, while delta 1 means that it's behaving identical to the security. And so an option goes through this convex path of, and this is where the asymmetry comes into an option, or the convexity of it comes in, which is that as you become right about a security and it starts going up, the call option starts behaving like the stock. And this is the key, is that so you can use the option to secure the purchase of an underlying security. But at the same time, when you own a stock, and let's say that stock drops 50% in its value, you are down when you own the stock. You are literally down half of your money. Like, you are participating on the downside at a delta 1, dollar for dollar. For every dollar it goes down, you lose $1. But with an option, your risk is always limited or defined by the cost of the option. And so you can't possibly lose more than what you outlaid for the contract. Right. And this means that you can define easily your downside risk while having all of the upside potential if you're right about the security. And this is done at a cost. An option isn't for free. You pay for your the ability to do this. So what happens is that the option is moving at this rate of delta. So now I think that's enough for what we want to do. I think the most important takeaway that I want all of our listeners that are listening to this to understand is the more right we get on a security, the more the option behaves like the stock, and the more and more money we make on the upside. While when we're wrong about the security, our risk is defined and the rate of loss is perpetually slowing the more wrong we get. And so there's this beautiful asymmetry that we're buying with an option. And this is so important when taking into consideration volatile securities like resource stocks, whether we're talking uranium stocks, energy stocks, whether we're talking basic material stocks, coal stocks, it doesn't matter, and including gold miners, they're very cyclical. These stocks will double in their value or get halved very easily. Just the volatility is extraordinary, and using options as a way to manage this volatility is such a powerful tool, George. It's just so important for people to learn how these options work. It doesn't mean you'll always use them, but if you don't educate yourself on understanding how to execute trades with options, you're cutting yourself short, because an investor only has two choices: buy or sell. You can either buy the stock or sell it. That's the only two choices you have. But once you get the options toolbox into your, into your investing strategy, you can generate income off your investments. You can buy protection on your investments. You can leverage the gains on the upside. There's so many amazing things you can do beyond being restricted to just buying or selling, which is the only thing a traditional investor can do.
Right.